Welcome back to Golden Rule Radio, a weekly update on the precious metals market where we focus each week on what's happening in the markets related to the metals and the fundamentals that move those markets. So starting with gold. Gold is holding above the brief trend line built last week. There's divergence on the upside, so same story as the last couple of weeks. Break above 1300 would be very strong. A correction down to 1225-ish is still completely reasonable, above both the 65 and 40-week moving averages. And the news from North Korea last week did push gold up, but it did not break that previous high of about 1295.
You know, you tie it to the geopolitical scene, Robert. I don't think it's, coincidental that the dollar's up. We'll talk about that in a little bit. But gold is also up and holding above those trend lines. So that's pretty bullish when you see wind in the sails from the geopolitical scene. What about silver?
So we've been waiting the last couple weeks. Silver did finally break above that 1690 level. Not only that, it came up and took out some orders at the next resistance up at 1720. So the pullback we saw here following that is just cleaning out those orders, and now silver as of this morning is on its way up again. I think our next potential stopping point is about $1 higher than where we're at now, about 1770, 1780, and that actually would put us above the descending trend line that we've had sort of wedging the silver price here for the last couple years, and that would be very bullish for silver.
Big picture with silver is that I think that in a few years we're going to look back and wish that we would have mortgaged a house to buy silver. But until then, silver needs to make up some ground. It needs to build some more of this base. It needs to move higher. It seems like it's just having a hard time going up.
It really does. I mean, even narrowing the gap between it and gold, it's not keeping pace still when gold moves. And again, it's depending on what's moving the gold. But we had a listener question regarding the silver cross that just formed. Does that change your outlook at all, Miles?
Moving average crosses can be a good indicator along with a lot of other good indicators, but like usual, I think you need to look at a couple different things. I've talked about the concept of indicators lining up at certain price points, and that adds some strength to the direction that we think the market might move off of those indicators. So yes, I'm a big fan of gold and silver crosses when you see those moving averages intersecting, crossing over, changing directions, but you can take any two time frames and call it a cross. So that's where I think narrowing it down to the ones that really matter, maybe the 50-day, the 200-day, which is the 40-week, and then of course the 65-week, the long term.
So you're sticking to your 1770 resistance point for now. Nothing's really screaming at you that silver's going to break out above that.
It needs to prove itself, I think. And I think Miles's key word there is time frame, because I think we have a lot of listeners, a lot of investors who are positioned in silver kind of getting tired of watching it under $20. I mean, I would say that some of our IRAs that are heavy in silver, their patience is wearing thin. And I would say to just try to muster some more patience, be positioning in silver, even if it goes lower, leverage again, buy more silver, because it's kind of like a position broker would do back in the day. They'd position in an asset that they think is undervalued and they'd wait for it to perform. You just need to sit tight. Silver will in the next few years perform. It's undervalued. You need to be buying it. Even if it goes lower, buy more. But it still needs to prove itself, I think, with the technical formations that we're looking at, right? I mean, it just seems like it's having a hard time going up.
I don't think you can ever underestimate the power of human emotion, and I think Robert brings up a good point. We've been under 20 for a long time. We know where the resistance points are. We know where the support levels are. You know that prices in any asset class is going to bounce between those as they go the direction they're ultimately trying to get to. But yeah, the timing is a big issue for a lot of people, and emotionally it can be very stressful.
Well, and Robert's point about mortgaging the house, looking back and wishing that we had done so and acquiring more silver, I think we're going to see the same thing with platinum.
Absolutely. Platinum triple bottomed. And since we pointed that out a few weeks ago, it has risen almost $100. And you may never see platinum sub 100 or 1,000 again. Same thing happened with gold. I mean, I think this is looking like, your last opportunity to be buying platinum under $1,000, if you can even actually buy physical platinum. You can't buy physical platinum under $1,000 right now. So yeah, looking at that chart, it looks pretty healthy, and platinum is about 25% below the price of gold, which hardly ever happens. So it's a deal.
Palladium is about to put in a new interim high, and push us a lot closer to its all-time highs as well. So that's something we may see happen even before this show goes live.
So as we transition into other markets, I just want to remind you that last week we had a fundamental show and we talked about our concerns about the equities markets topping, and we did see some pullback last week, and we've seen some recovery. What do you think is driving that, Miles?
Looking at the other markets, I mean, the Dow did hit 22K. It did pull back a little bit. It's now back a few dollars above it at this point. Don't know what else to say on the Dow. Months and months of divergence, lots of technical reasons we should see a pullback. A lot of Federal Reserve and European central banking reasons that we should start to see the stock market pull back, which we're going to get into here in a second as well. Likewise, the NASDAQ came within, $4 or $5 of the 6,000 mark we called for, and the S&P came within about $9 of the 2,500 mark we called for. If we start to see the weakness in the Dow, they're all turning down. The only thing that took a decent bounce back up this week was the Dow Transports, which we mentioned a couple weeks ago. While everything else was going up, they were falling.
So it's still summer and we're still talking about the water slide, which is the dollar. And it looks like the dollar is going to have a little bump here in the water slide before it continues a bigger decline ultimately. So it reminds me of, a water park where somebody's going down the slide, they catch air off that bump. I don't know how high we're going to have an interim rally here with the dollar, but we are above 94 right now. And I think it's possible that we could see 98, 98 and a half before we resume the primary trend on the dollar and it goes farther down below where it stopped around 92 and a half. But it may not go up to 98, but that's just possibly the range where I'm looking at. It may stop shy of it.
It might too, because the Fed has come out and said they probably won't be raising rates again this year. Tough to see a significant dollar rally in an environment where there's no rate increases. So, we saw a big decline in the dollar, and we talked a couple weeks ago about it being down 10% on the year, and we've erased some of that. And remember that those were inflationary concerns based upon the Trump presidency and his desire to have infrastructure spending over $1 trillion, a tax break, a rewrite of even the tax code, and that he was intending to build the wall. So those were all very spendy things that were driving the concerns for inflation, both from a Federal Reserve standpoint and a consumer standpoint. None of those are playing out, right? Every time he turns around, it's looking like it's going to be 6 months or a year down the road before that topic's even brought back up. So we do expect to see a little bit of a deflationary wave roll through on that type of news.
So, Tori, you mentioned central banking, and I think we have to bring up the fact that the Germans will be bringing the European Central Bank before the European Court of Justice to review the current program.
This just really bugs me because the whole concept of creating money out of thin air, creating money that didn't exist by hitting some numbers on a computer and hitting enter. The European Central Bank created, I think by the end of their bond buying program, it'll be the equivalent of $2.7 trillion that didn't exist before to buy European debt. And the Germans, less than 80 years ago or so, did exactly that with their mark. They printed money to buy their debt. They caused a hyperinflationary environment. I think a lot of our listeners already know this story. And the European Central Bank has done that same thing. The Federal Reserve started doing it. The Europeans adopted it. The question about it being legal or not, it doesn't really hardly even matter because
moot.
If they have an outcome where they say that it is legal, well then okay, they just have already created $2.7 trillion and it's legal. Great, everybody cheer. If it's not legal, what does it even matter what they decide? Because they've already done it. By the time they decide whether it's legal or not, the 2.7 has already been created.
Right. And it was never the intention of the European Central Bank to be able to money print. Remember, we had this debate in the middle of the financial crisis and everybody yielded to it. So here's Germany late to the show. That's the strategy that all lawmakers pursue, right? They pass a law knowing that it's going to be challenged in courts. It takes years. And in the interim, they've enacted that law and the damage is done. You cannot go back and recoup the expense or the way that those monies were directed.
How do you trust a system like that?
You can't. And we talk about inflation and money printing. Well, look at the credit markets. Same thing, right? They can expand credit. They're printing money out of thin air by expanding credit. We just saw the 12th straight quarter of an increase in household debt. Americans are re-embracing now credit. And we saw this in 2000 to 2008. Same sort of a mindset. You now have household debt at $12.8 trillion. That makes the bond buying program look minuscule. All central banks' balance sheets now are 14 trillion, right? We mentioned that in a show a few weeks ago. So now in the second quarter, it's up 1.3%, this household debt. That's a $550 billion increase off of debt. That's rising mortgage debt, auto loans. Come on, people. Don't fall back into the same exact trap. That's 67% of the second quarter GDP, the nominal GDP. 67% of it came from credit.
That debt will matter, and the currencies that you hold will matter. Whether you're holding euros, dollars, yen, I wouldn't hold any of those long term.
They're all fiat. They're all declining. They decline at different rates, so it makes one look stronger on any given day or at any given moment. But we had a listener question this week, IB 12541, asking us to discuss how to try to save in this market. How do you try to save in this market? You move into tangible commodities, period. It offsets that money printing. It makes you immune to those debt issues. You're not at the mercy of somebody else's debt obligation. Own your own physical, tangible commodities, primarily precious metals.
Thanks for listening this week. It's great to be back, all three of us in the office. We enjoyed seeing those of you at the conferences. Thanks for coming. And we will be doing another set of conferences coming up in October and November. So be on the lookout for dates and locations.
Subscribe to us by clicking the subscribe button below and give us a call, 800-525-9556. We always look forward to an opportunity to walk through your portfolio and come up with solutions with you.
Tune in next week. Thanks for listening.